All right. Hello, hello. Thank you for joining us. My name is Daniel Parzivand. I'm the Chief Officer here at Rentastic, and I am very excited to meet everybody and get this started. So, first, I'd like to introduce my partner and dear friend, Roy Dekel. He's the CEO of Set Schedule, the largest community and social app for real estate community in Rentastic. Roy, thanks for joining us today.
Well, thank you for having me.
It's our pleasure. I'm really excited about this. I know obviously you come with a lot of experience in both real estate space as far as buying and selling and investing, as well as the tech space, and we'll talk a little bit about that. But before we get started and jump into all that, I do want to spend a little bit of time talking about the agenda today. We're going to spend some time talking about the portfolio profitability, understanding it, navigating the housing market, property level analysis. And we're going to talk a little about some of the tools available in Rentastic to help with all these, which includes the deal analysis, the mortgage calculator, and obviously the rent estimator. And then we'll get into Q&A. So if you do have questions, feel free to start to type them in the chat, and obviously I'll present them to Roy. But Roy, why don't you give some of the listeners and everybody a little bit of background about yourself and kind of your real estate and tech space experience.
Well, sure. Since you asked, and by the way, everybody, this is going to be super informal in concept. The idea is obviously to bring as much value as we can to you. So, open forum Q&A. We're here to address any suggestions, concerns, questions about the market, about the tech, about any challenges and solutions that you're looking for. So again, be fully, and we're super happy for interaction. My experience, I mean, the last better part of the last 15 years after serving in the military as a SEAL operator and an officer, I came to the United States and basically got involved from early stage. Got involved with basically real estate investment, real estate investing. The U.S. real estate market is always attractive to anyone around the world. So spend a tremendous amount of time investing primarily in the states of California and Texas. Looked into different regions as well, but traded thousands of properties over the course of years. And ultimately, fast forward between actually right at 2009, 2010, the Great Recession, that's where we had really the peak of investments. And as a contrarian, as a serial entrepreneur contrarian, bought a lot of property during that period. Fast forward to around 2014, Woody Dorner and I and Danny, we kind of basically partnered around the common ground of a challenge in the world of real estate, which revolves around deal sourcing, networking, partnership, and basically real estate growth, whether it's through sales and buying, or buying and selling real estate, or whether it's engaging and working with real estate agents. And ultimately, we formulated and founded a company called Set Schedule, which, as Denny mentioned, is the biggest social app and community of real estate professionals. We have over 70,000 agents and brokers and mortgage officers there. Different universe, but that's basically what the catalyst. it's the catalyst that enabled us to acquire Rentastic about a year and a half ago. And we've acquired Rentastic because we have this innate obsession of bringing solutions in the world of real estate. And since we are very passionate about this business and understand it, we decided that Rentastic was a very good fit for our personalities. But more important, we really loved the engagement with the customers. We really, not sound super cheesy, we loved you guys. I mean, it was a very good experience, and we saw that the platform solved a lot of challenges for real estate investors, which personally I'm very passionate about. So we took the bull by the horn, and we are basically on a very clear direction and a marching order of making Rentastic great and supporting every single customer/user on a platform, regardless if you are a subscriber to the premium program or if you're just using for a single property or whatnot. We're here to help you grow your portfolio. We're here to grow your knowledge base as necessary, and really basically give you all of the alternative solutions that QuickBook cannot. So that's my background in 60 seconds.
Awesome. Appreciate the 60-second background. So obviously today we're here to talk about portfolio profitability. Most people have an understanding of their overall profitability, but when it comes to the individual properties and I like to say it's kind of like a serial entrepreneur, like you said, each each property can be its own book of business, right? Each property could have its own analysis and its own directive around income and profit. And we've come to see that a lot of our users don't have the necessary, I guess, the necessary training to understand how, one, they can analyze properties to see if the potential property is a good deal, and two, how can they take a current property that they own and make it just a little bit more profitable, especially in this market with it being rental being so dynamic. So let's really just jump into it and kind of give you the horn here, Roy, because I know navigating around the housing market and everything that comes with it has been something that you've experienced, like you said, both in the highs and the low. So if you can get into that a little bit, I know we have some of the topic points, but I'll let you kind of go on your kind of go on your own speed and talk about what you think is informative for the listeners. But give us a little bit about, how is it that you stayed ahead of trends and what you learned and what are some of the strategies that you implemented?
So before I answer that, and thanks for the questions and the guidance, Danny, I want to again challenge every single listener to really take the initiative to connect with us, to connect with our team. Unlike QuickBooks or Intuit, our mission statement is to actually to speak to every single user, to help every individual customer, every individual partner, whether it's doing a bookkeeping session, integration session, or even consultation. Any questions that you may have here, we can even take it offline on a one-to-one. On one-on-one, I should say, and really address your Rentastic instance if you need full integration, if you need to help us basically transition a lot of transactions, all of that stuff. I really want you to understand how much we care, and ultimately we're here to speak and to navigate with you around the course of real estate investment and everything that has to do with analysis and growth of the portfolio. So Danny will share calendar schedule for the team, and we'll be very happy to chat one-on-one very soon.
With that in the chat.
So it's in the chat. There you go. With that said, again, I'm coming from a point of view of providing kind of like a levelized playing field or a basic benchmark of information. Some of you may find it redundant, some of you may find it interesting, but ultimately, like I said, I don't know from the plethora of customers, I don't know what your level of knowledge base is. So if you have any questions, just shoot out your Q&A, just put it out on Slack. Danny will monitor the questions, and we're happy to answer them in real time and live. But ultimately, navigating the market, you asked how or what drives success. Predominantly speaking, I'm not a creator and the inventor of it. Being a contrarian is the number one driver of market success, especially in real estate. As Warren Buffett said, if they invest, run away. If they run away, invest. And it's really true. And the exciting period that we currently live in, I think, based on data and obviously track record, is an amazing time to invest. All of this uncertainty around mortgage rates and all of this uncertainty around the residential lifestyle, and quite frankly, all of the uncertainty around commercial properties post-COVID, I think created an amazing opportunity to be a contrarian, to be successful. Like I said, my most successful investable or investment years in real estate were 2009, 2010, 2011. I mean, these are the aftershock years where you actually bet on the market. If you're betting on the fact that the United States is going to stay solid, strong in terms of economic growth and economy in general compared to the world, then you should invest in real estate. If you believe in the fact that real estate land is limited and you cannot manufacture land, then you should invest in real estate. And if you believe that the density aspect of the United States compared to India, for example, or compared to even China, is much lower, which means there's tremendous amount of growth in real estate development and real estate investment, then invest in real estate. So the number one thing is be a contrarian. Number two things, believe in the US market and keep being positive, especially as a real estate investor, that the United States real estate market is strong, solid, and is really in a position to keep growing. I believe that mortgage rates are going to go down. I believe that a lot of people on the call share that thought, but ultimately, it's the inflation rates. Yes, in January didn't go as down as down was defined by analysts, but the truth of the matter is it did cool off compared to December. Inflation rate did cool off between 2023 and 2022. So whether it's the first quarter aftershock of 2023, whether it's the next 60 days of giving it some natural time to progress. At the end of the day, 2024 will be a year that we'll see some reduction in mortgage rate. And that's going to really drive on the retail front, meaning the buyer, Joe, and the seller, Mary, an instinctual desire to, it's the fear of greed, right? It will be an instinctual drive to greed and an instinctual gravitation to greed versus the fear, right? So the seller will need to sell and they'll need to buy, and they'll buy in a lower mortgage rate. So anywhere you cut at being a contrarian this time of the year, and this year is a phenomenal time for us to play and to invest in the market. I also think that we need to be, as much as possible, agnostic to or divorced from emotional newscast media statements, right? I mean, the ups and downs of the market. Like, for example, yesterday, the market tanked. Anybody who was invested in stocks just hit. Today, the market went up, right? Balancing basically 90% of the losses of yesterday. So there's a lot of emotional base perceived facts, which are not facts, they're emotional opinions. And I believe that as investors, we need to divorce ourselves from that, and we need to stay hyper-focused on the quantitative side, on the data side, on the analysis side, on the whatever system you pick to choose side, to analyze the facts and the data as much as humanly possible, and divorcing yourself from the temporary emotion. The emotion or the judgment calls should be the final component of the quantitative analysis. And that's currently how we see the best path of navigating the housing market. Danny?
Yeah, love it. I think the important aspect of this, and something that most real estate agents, real estate investors need a little bit of help with, Roy, is some of the strategies that we deployed or that have been employed. I mean, I know that you said to detach emotionally. Are there any strategies that you had that worked for you when you were investing and buying? And if so, would those still be relevant to today's market?
Well, the short answer is yes. There are always strategies that are the core foundation of any investment, right? And if I have to sum it up, like I said, number one is be hyper-focused on quantitative analysis. So suck in as much information and data that you can take from unbiased sources. And try to do it in multiple ways, right? So try to get at least 2 data points, 3 data points, and compare them. Create the CMA, the comparative market analysis, and put them together into one single source of truth, whether it's software or Excel. And we're going to talk about Excel in a minute, and its bad challenges and issues and why you want to divorce them, but without trying to be commercialized here. Really, I mean, have the tools that you need to plug in those multiple data points to create one single source of truth that can spit out, for lack of a better term, a projection for your analysis, both on potential acquisition or current optimization of your asset. Current optimization of the asset, and Danny, you said a couple minutes ago, how do we optimize that? I don't want to fast forward too much, but ultimately it's pretty simple, right? Increase income, decrease expenses, right? Easier said than done. You need to figure those out. You need to leverage the tools to really understand how can you really increase income. Is now the time to increase income? Or maybe this is more of a prudent time frame to reduce expenses and maintain the same income, to maintain loyalty and to maintain customers, maintain renters, maintain Airbnb renters, right? I mean, we've seen a lot of case studies from different style investors with short-term rental, long-term rental, or even buy, fix, and flip. Which I was intimately involved with large companies that done it in tens of millions of properties per year. So the reality of it is that you need to have multiple data points. You need to fit it into one single source of truth. You need to divorce yourself from the emotional opinion first. You need to define your benchmarks, and that's how you should run your studies.
Awesome. And obviously, we're going to go into some of the tools later on in this conversation that investors can use that are Rentastic based, and everybody who is a Rentastic user has access to these. And if you want, a larger access, obviously there's availability for that. So let's kind of switch gears a little bit and talk about actual understanding of the your portfolio profitability, what it means, and kind of, like you said, a little bit about spreadsheets and why we want to divorce that. When it comes to the profitability, and we always talk about why, right? Why is this so important for an investor to be in tune with their individual property rather than just their entire portfolio?
Well, that's a phenomenal question, Danny, and I'm sure that everybody has it as part of their top of mind, because the reality of it, we don't buy properties to lose money, and we don't start businesses to fail, right? But the truth of the matter is that I would dial the question to be more in lines of how do we actually maintain full control and understanding of our true profitability? True profitability sometimes is different than the regular profitability or what we perceive as profitability. And I mean, I want to share a quick story about a friend of mine that his wife is an Ivy League graduate. That basically became a very successful ophthalmologist, basically eye doctor, ophthalmologist
Optometrist.
for animals, so veterinarian, so and graduate from the best schools in the country, in the world for that matter. But the funny thing is, when we were looking at the data analysis of the business for the purpose of acquisition, she had nothing. She had the P&Ls were not recorded correctly. The data was completely not in line with what she thought the numbers were. She was successful, or she perceived herself to be successful, but ultimately, when we look at the data, the business was successful, but it took us about 3 months to get to the point where the M&A brokers were able to even analyze the business, to put an evaluation on it. And that was a time bleed and a time span which she, was at the point where she already wanted to sell the business. So the more point of the story was that knowing your numbers is not the same as wanting to be profitable. So it's two things that are very important to be combined into one. And in order to do that, you first off have to really define your goals. Right? I mean, what do you want your benchmark to be? How much cash on cash you want to make? How much, fixed income you want to make from the money you invest? How much you want to borrow versus how much you want to come out of pocket? And ultimately, how much risk or how much tolerance you have for the peaks and valleys, and what's your time horizon in terms of holding the investment, right? So there are a lot of key metrics like the cap rate, the ROI, the NOI, and a lot of other things we're going to speak to pretty soon. But it's super critical that we focus on categorizing and constantly tracking our income and expenses from the bank system and the credit card system and any other financial data that we have, to make sure that at the end of the day, we don't think that we're successful or unsuccessful. We don't think that the property is profitable or not profitable, but the numbers are not showing that. And that's kind of like the goal of today's session. It's really to get to the point where there's full transparency and clarity, to the point that where you can transition this portfolio to another investor and they're able to audit the numbers and say, okay, that makes sense. And it doesn't, A, give you a scenario where the property is not profitable or not profitable enough, and B, it doesn't take you 3, 4, 5 months just to explain another investor the data set of your property. So it's super critical that we keep track of the key matrices, which we'll define today, and that we're constantly tracking them.
So let's what do you say we just get right into it? I'm going to go ahead and swap over just so we can start the screen sharing. But we're going to be screen sharing is going to be tools that are absolutely available to all of Rentastic users. We're going to be talking a little bit about the deal analyzer, mortgage calculator, and the rent estimator, right? And Roy, if you could walk us through, as I go through this, obviously, you could walk us through kind of like the thought process of, and I'll show examples of 3 different property analyses, and you could kind of break down what works, what doesn't work, and if there was any changes we could make, right? So we'll start with the current property, and this is what we consider an excellent property, right? When it comes to the net, when it comes to the key performance indicators, they're all green. And we've talked a little bit about CFPU, cash flow, cash on cash, cap rate, and 1% rule. So the beauty about the tool here is you're inputting your purchase price. You can add closing costs, repair costs, and if there's an ARV, so if there's an after repair value to it, the down payment, interest rate, mortgage length, and then obviously this will indicate and spit out the monthly expenses, which can also be altered a little bit more if you wanted to go more granular. But for the sake of simplicity, because we know how complicated this can be, we're just going to stick with the purchase financial details, and then obviously what you believe that property could be rented for on a monthly basis. And this will spit out a fairly detailed calculation on whether this is a good deal analysis or not. So Roy, can you walk us through some of the indicators here, and what do they mean?
So obviously you have the index there to explain, technically speaking, what everything means, and I don't want to bleed 15 minutes of explaining the terminologies. But what I will explain is that Danny would share 3 illustrations showing best, better, and worse, or worse, better, and best, better yet. And this is the best scenario. You obviously need to be cognizant of your goals, like I said in the prior slide, because ultimately capitalization rate, right, which is ultimately what you earn over the gross acquisition price of the property, it fluctuates from market to market, right? I mean, for example, a property in Beverly Hills or in California would drive different capitalization rate versus a property in Dallas, or a property in Detroit, or a property in Miami. So there's a fluctuation around cap rates, and there's fluctuation around obviously purchase price appreciation rate, and ultimately cash on cash. I've seen a lot of friends of mine in the California area really working on 5% cap rate, which in my opinion is sometimes it's relatively low, and I personally am not in favor of having a cap rate of lower than the 5% range. But in California, there are many scenarios, especially in Los Angeles, which is a high density area. Those are, in many instances, the cap rate. So what you need to just understand is, first off, the definition of the terms, and ultimately you need to have the understanding of the definition of your goals. Like, for example, back to my friends in Beverly Hills or Los Angeles or San Fernando area or San Diego, these guys are actually banking on long-term appreciation, and they're trading properties after 5 years, 10 years, and they're making tremendous amount of dollar volume, right? It's dollar volume. Sometimes the percentages of the appreciation is really good, but really their play is overall asset appreciation. So Danny, I would probably go over illustrations a little bit.
So to start, the platform. So what you were referring to is, I mean, obviously this is a great example, and here we have an example that might be good based off of the cash flow, and you still have a 7% cap rate versus what we're looking at, which is this is a very low valued property, right? If anything, your cost to your CFPU is really only about $36, which is considered low, and that's obviously with not having any of the maintenance fees and all that. But Roy, so if I understand you correctly, if we took this example, right, the difference between a good example here where you have a pretty healthy margin versus your expenses of income versus let's say a $5 million property where you might not be able to necessarily, and this should be 1 more 3, I think, there we go, a $5 million property where you might not be collecting the $18,000 of the monthly expenses, where maybe you'd be able to rent that out for what, $12,000. You're still losing out on this, but the long-term play would be the value of the property goes from 5 to 7, and you'd be selling it out and kind of flipping it.
Correct. And you ultimately can amortize the $2 million appreciation into your long-term gains, right?
Mm-hmm.
But again, this is one business model. If you buy a property and you want to Airbnb it or Vrbo it, right? Or if you buy a property and you want to have long-term tenants, I personally, and this is my unsolicited advice, I hate the low cap properties. I'd rather go to different markets in the United States and focus on buying a $200,000, $300,000, $400,000 property. I mean, that's probably in the high in many different areas in the country, and have the entire dashboard green. I want to have much more than 10% on cap rate. I want to have cash on cash. I'd love to climb it to the 20%. And I like the 1% rule to be as high as possible above the 1%. So I'm having a complete green dashboard. And yeah, my personal thesis or hypothesis around real estate investment is that you should hold it for 10 plus years. But that's, again, my personal subjective opinion. And because my goalpost is 10 plus years of real estate investment, I really want to create a steady passive income and steady cash flow of income from real estate versus borderlining the buy, rehab, and flip. Which are good for short-term gain, but at the end of the day, between the taxation that your CPA is going to slap on you, or the IRS, better yet, short-term gain, short-term flips, it's going to become almost like an ordinary income. And the intrinsic risk to market, because you're flipping every year properties, to me, it's just like not within my comfort level. So I always prefer to be in the green dashboard here, Danny.
Which is what we have here, right? For example, $300,000 property, $4,500 rent. You've got a 623 CFPU. Cash on cash is almost 40%, and the cap rate's well above the 10% that you are comfortable with. And obviously, your 1% rule being the purchase price, and collecting at least 1% of that on a monthly basis is, 1.5%.
Correct. And I want to take the spot here for a quick commercial break. We're obviously utilizing the dashboard of the deal analyzer and analysis on Rentastic. And again, I'm going to keep pounding this thing. Use the calendar link and schedule a session for us to speak one-on-one and go over, even if you want to go through optimization ideas and how to make sure that the data is right, first off on Rentastic, and then do the optimization. We're fully receptive to do everything and anything to help you with your portfolio and your portfolio growth. But I do also want to take this opportunity to say that why we should stay away from Excel spreadsheets. Well, the reason is I've used Excel spreadsheets for years, and all of us probably use Excel spreadsheets for years. And it's super easy to, number one, have a formula issue and have a breakage in the formula. Number two, forget certain items in our formula. And as a result, really get A, to buy the wrong property or to close on the wrong deal, and B, also not effectively or in a very efficient way, try to optimize the expense ratio to income ratio. So that's what we're solving here with Rentastic. And I just wanted to make a point here to talk about the Excel aspect.
Awesome. Appreciate it. Anything else we could talk about on the deal analyzer? I mean, like I said, you have the ability to go very granular with the monthly expenses, which allows you to kind of put in utilities and property management, and if you want to even go as far as vacancy and so on and so forth. But for the most part, do you think there's anything that we missed here before we move on to the how do I understand mortgage and the rent estimator, which we'll talk about in a second?
No, I mean, everything else beyond this is a trick of the trade. It's just understanding how to optimize your acquisition, or to, even after buying, how you can, and that goes to the point of being more efficient. Maybe the right thing to do is to refinance with higher interest rates. Take the cash and acquire another property. So create a leverage play where specific property that, let's say, is extremely green, now I can pull out equity and get another property and an investment. So this dashboard really gives you a lot of cool tricks of the trade. And like I said, we can very well and very easily have a session where we kind of like go over optimization ideas or strategies around a portfolio. And like I said, one of them could be a debt scenario of leveraging a successful, strong property and building another one.
Awesome. Let's very quickly move to the mortgage calculator. Part of the analysis is to understand your monthly expenses around the mortgage. And there's tools everywhere. You can look up online free tools and all that. But the mortgage calculator, like as you can see here, you're going to put in the home price. You can put your down payment, the length in terms. So 10, 20, 30, 40, whatever this is, standards 30, and then your interest rate, right? You can do anything from just type in 7.254. And then you're going to decide if you want to do your BMI, which is your private mortgage insurance. Most of them don't. And then you calculate your taxes and insurance on top of that. So as you can see, based off of my tax input, my home insurance, and then the HOAs, on a $300,000, I have a monthly payment expense of about $2,000. So we take it one step further by allowing you to add an input so that this can be translated to your deal analyzer. And obviously, that will allow you to have a better understanding of your true KPIs around the possible deal. Anything I missed here, Roy?
No, perfect, spot on.
Pretty straightforward, right? Then we have the rent estimator. So it's a cool tool for you to calculate and estimate property rental. And I know that this is a very much asked for tool for a lot of investors because it can fluctuate, especially in a market like this. So Roy, can you give us a little bit about how you would and how you might use this tool? I kind of put in some information of my own property so we can take a look at a true example of what we're going to be working with.
Sure. And I'll start with a funny story. Prepping for the webinar, we kind of like went over the estimator to run a study and analysis. And we took first off the first property that you'll see from Danny, and there's a return number, right? And then before we explain the numbers, basically they said, well, I'm looking at what we're getting, our family, because this is Danny's holdings, and we're getting more rent than this, right? And I said, well, okay, well, here's a question. When did you lease it out? And the answer was 2022. And I said, okay, well, let's run 2 more properties. And we ran actually my assets, and they were spot on. they were spot on to where I guess this is how much I'd lease them today. And those properties are not leased out. So that's how much I would lease them today. So the truth of the matter, whether we like it or not, in 2022, we had over 9% inflation rate. Rents went up through the roof. But quite frankly, between the end of 2022, 2023, and absolutely still this quarter, rents started to go down a little bit. They were starting to levelize down. So when we really studied the product to make sure that, you know, we always QA our own product, we always QA our own tools, we wanted to QA it again right before the webinar, and we've came to realization that it's actually spot on. So the way I would actually treat it is I would treat it as a CMA, as a comparative market analysis, something you probably can get from real estate agents. The good thing is that you don't need an agent here. You just run your own CMA, you run your own market analysis. You can look at the range, and I would probably discount the top of the range, the 28.19, and I would probably discount the top of 46.27, and I would project my analysis and plan somewhere in the 70th, 80th percentile, somewhere around that range. So the 37.23 to possibly, I'd say even 4,000 a month would be somewhere around the secure, conservative, safe CMA, comparative market analysis. Not to say that you can gust it up by 10% and get another $500 a month. That's just the reality of things. At the end of the day, sales is emotional, and you may get a renter, a tenant that is a good tenant and perfect tenant, and actually they want to pay more. But ultimately, I'd go with the 80th percentile and 80 percentile, sorry, and I will also run the analysis on that.
Awesome. Yeah, and the cool thing is this is kind of in real time. So a lot of the data that's out there would pull it, and it'll provide you an estimate, like Roy said, from the lowest to highest. And appreciate the 70 to 80%, because I think that would have been my next question. Is right. There's such a long range, so you kind of defined that for us as well. And then this is awesome. You take this, throw into the deal analyzer, even if it is an estimate and not an exact number, as of when you're looking at a possible deal. It's a good way for you to kind of get a good range of looking at territories or looking at areas that maybe you haven't invested in the past, and you're looking to possibly break into new areas. I know some of our users have done that, Roy, where they've used this tool to look at 5 or 6 different properties within an area to see if it's maybe an upcoming area where they want to start to make investments and buy properties and break into their first property there. So awesome. So you've got the rent analyzer, you've got the mortgage calculator, we've got the deal analyzer, Roy, and it seems like we've kind of put the puzzle piece together. What else is there as far as information that we might have missed before we kind of come to an end on this podcast or webinar, I should say? Used to
well, I mean,
podcast
all the time. I can. Well, I said it's super informal and a casual conversation. We could talk for hours about this, and we're happy to do this in a one-on-one session. But ultimately, unless we have some questions to get a little bit more of a direction from the team here, we pretty much cover the basis of the foundation.
Awesome. Well, it doesn't look like we have any questions, so I guess we've answered everybody's questions as of yet. And generally, we'll get questions after the podcast or after the webinar, and we'll be posting this on YouTube and so on and so forth. So happy to address any of those afterwards. Cool. Sure. Well, Roy, thanks for joining us. Appreciate your time, and thank you all for joining us as well. And yeah, good luck. Happy hunting. Bye, guys.
Thank you.